everybody? So we're back at it, USDJPY, and given how this week played out, I want to do something a little different in this video. I want to talk about the three pillars of a successful trader. Essentially, the three elements that I find the most important if you want to stay in this game for the long run and you want to grow and be consistently profitable over time. So, I've mentioned in previous videos how it's unwise to copy trade from anyone in the market. First off, to develop your own skill with trading and with analysis and with psychology and risk management, as we're going to talk about, that is so paramount. It's so fundamental. And it's wise to understand that there's nobody in this market, no matter how good they are, no matter how good you think they are, how good they say they are, there's nobody that is going to give you a guaranteed trade. There's no such thing. You might have some people that have an exceptional win rate. They're extremely good at it. You might have some people that maybe their win rate's not that good, but there are other elements that make them actually profitable. So first I want to demonstrate what happened last week. And this is what I was talking about. I was very bullish on this. I was thinking that this zone was actually going to hold out and we were going to see bullish price action. But as you can see, and as those of you who traded this saw, we had a secondary imbalance happen right here. And that ended up causing price to cascade downward. In other words, there wasn't enough volume that came from this sweep down to actually push price higher. And, there's reasons behind that. There's always a logic to what's happening with price. But the thing is, this is a complex game. People make mistakes. You might have a clear indication of why something's happening, and it might not play out that way. And so, if you were to take any signal or any analysis you have of your own and assume that it's a guaranteed win, then you're going to get hurt because you're not going to be thinking properly. The market is a game of probability, and we need to understand that. Now, just quickly analyzing what actually happened with this and why this might have gone lower. First, we had this point that actually locked in seller volume, and then we had the point that broke it. And then this candle right here, I think this was a significant telltale sign. This gapped low. And whenever the market gaps, it tends to fill that gap. I just was assuming that it wasn't going to actually break down below this. So for myself, this is a trade that I was incorrect about. And it happens to the best of us. It happens to everybody. And that's why I always emphasize it is not wise to just blindly take someone else's trade. If someone's saying, hey, I think this is what's going to happen, and you're just going to say, oh, well, this person said that, well, cool, I'm going to bet the farm on it, then you're probably going to be disappointed. I mean, at some point or another. This is what I want to get to. So what I call the three pillars, the three elements of what makes a successful trader and what's actually going to have you staying in the game long term. So technical analysis, which is most of what I cover on this channel, and as we go, I want to cover more elements of risk management and psychology, but technical analysis is an art that a lot of people, they seek. It's sought after. It's something that is very important to your charting, but it is not the most important, and I want to explain why. So the most important thing to your trading is your psychology. It's your ability to manage your emotions. It's your ability to understand how you're going to respond to a win, how you're going to respond to a loss, and understanding the difference between gambling and trading. So first off, in a situation like this, let's say you followed what I was doing on this and you actually bet long on this. You entered a long position and then got stopped out on it. Depending on how you are viewing the market, like I said, gambling or trading, if you were saying, okay, this is guaranteed, it's for sure going to do this because we saw this and this happen, and let's say you over leveraged. So, let's say you had an account that's, for example, let's say you had $10,000 in an account and you want to risk 1% of that. So you're going to risk $100 on a trade. Okay, so that means that for every trade that you take, the maximum amount that you're going to lose is $100. So you could take 100 trades and it would take 100 trades to actually lose that whole $10,000. But let's say you risk 10% on it. So you were risking $1,000 per trade. That would then it would only take 10 trades is now what your account is worth, right? So that means within that series of 10 trades, if you lost 10 trades in a row, then you would lose your entire account. So there's nothing wrong with either of these, I'm going to say. And that's because it does come down to how you are able to respond to a win or a loss. Some traders are able to really take huge risk and understand that, okay, like let's say you had this $10,000 and you were risking $1,000, and let's say you lost 4 trades, so like minus $4,000, and you're in the hole, and now your account equals 6,000, right? If you were in that position, you had $10,000 and now you have 6,000, how's your mind going to be thinking? Are you still going to be approaching each trade with a relaxed state of mind, with an easy, like, yeah, no problem, I can let the probability play out? Because remember, in the market, if you were to jump in here having no technical analysis at all and you were just to place random buys and sells, by probability, you would win 50% of the time, right? So if you just let the odds play out, in other words, if you let the probability play out, technically you would eventually come across a trade that would bring you would gain your profit back from it. But if your psychology becomes compromised by taking such a huge loss, right? Because that's 40%. That's a 40% loss on your capital, just in this example. If that were to happen, would you still be thinking rationally, or would you be thinking like, oh no, I lost this money, now I have to make it back? See, that's when we kind of trip this. That's when we go down a road that it's difficult to come back from. Because if you're trying to make up for your capital, or likewise, let's say on the other side of it, let's say you have $10,000, you risk $1,000, and this is where a little more we're going to tie risk management in here a little bit. So let's say your risk to reward, for every $1,000 you're trying to make $3,000. Okay, so you're trying to get 1 to 3 on your risk to reward, and that'd be as simple as like, okay, you're taking a trade right here, and your stop loss is up here, 1.54, and boom, 1 to 3, right? So your trade, for every X amount of pips, for every X amount of percentage that you're actually looking to gain, let's say in this case, like I said, it was that $1,000. I don't know why I deleted that. Maybe I deleted that. But let's say no, there we go. So your $10,000 account, you're going to risk $1,000 to profit $3,000. Okay, and this, like I said, this is high risk. This is you're risking 10% to make 30% on the account. That's huge. You could take a 0 off of this and be more rational about it and say, I'm going to risk 1% to gain 3%. Okay, so these are different ways to risk reward. But like I said, some traders can handle higher risk to reward. But if you were to put yourself in the position, or if you have experienced this in your time trading, where, okay, let's say you won 2 or 3 trades in a row, and now your account, oh man, this is giving me some trouble. There we go. So you won, let's say, 2 or 3 trades in a row, and let's say now your account is 19,000, right? So you won those 3 trades in a row, and after having that winning streak, imagine now you just had a 90% gain on your capital. So from there, can your mind still be thinking from that like 1-to-1 place? Can you still be thinking at that point? Are you going to get cocky? The same way that I said, like, imagine that you lost 60% or 40% of your account. You took this huge loss on it, and now your brain's trying to be like, I have to make up these pips. Imagine now the other side of it, where you got a huge win, and now let's say you throw this out the window. You throw the risk to reward out the window, and now you start just taking whatever you want. You up the leverage, you up the risk, and now you start trading recklessly. So it happens on both sides. And it's important to recognize how you respond to it. Like I said, this is not something that it's like someone can just give you the magic number and like the magic way to do it. The way that I look at this is you need to understand based on how much money you have and based on how much you can win. In other words, your hit rate, how much you can actually win in the market consistently, and what sort of trades you're winning consistently. So, right, this is a for myself personally, I usually don't like to risk this many pips. This is just for an example. I usually go to the smaller time frame and find something where I could get, say, because this is a big trade. This is a 175 pips win for our, yeah. So this is like a several hundred pip trade for 64 pips profit. It's still a 1 to 3 risk to reward. If you're going to take trades like that consistently, and this 64 pips, you're going to do the math and figure out what lot size you need to use in order for that to be a certain percentage risk on your account. I don't like that saying 1% because that's 10%. So, excuse me. Here we go. You need to understand that the principle of winning successfully over time is to have a slightly higher than 50% hit rate, or have every trade that you win be at least 1 to 2. In other words, for every X amount of percentage you risk, say for every 1% you risk, the trade that you're going to win is going to be either 2 or 3%. Or if it's you like to trade super big, for every 10% you risk, you're going to make 20 or 30%, depending on your psychology, depending on how much you can actually handle risking. Because a lot of traders, we forget that as much as we can be confident about a position and say like, oh, this is definitely going to go long, this is definitely going to happen, it's important to have that confidence because then you'll execute on it. But you have to keep in mind that you could be wrong. It's having that humility to understand that this market can be so unpredictable, and if we let it sway our emotions and we forget about how much we can lose in a position, we're we're gonna mess up, right? It can be easy to be like, oh, there's 200 pips to this upside. Yeah, I'm gonna bet the farm on it. I'm gonna risk 10% or I'm gonna risk 20%, and then it goes against you and you have this huge loss. How's that gonna affect your psychology? Especially then it's like, let's say that just destroyed your psychology. Now you're all depressed, and now the next trade comes along and it would have been something you would have really easily taken, but you're not in the right mindset to take it. So this is a difference between gambling and trading, right? We need to have the humility to understand that this is a game that is based on probability, and that means we're not always going to be right. So we need to manage our risk. We need to be defined about how much we're willing to lose in a position and how much we can gain from it if we're expected to gain from it. We need to understand, am I winning 50% of the time or am I winning more percent of the time? And this, my friends, is where technical analysis comes into play. Because technical analysis, where it's something that's very sought after, people think it is like the answer to trading. It's actually the third, based on these, most important thing in the market, because all technical analysis is improving your win rate, is improving your target accuracy, and it's improving your stop loss placement. So on a trade like this, my technical analysis, and as you all know, as those of you that have followed me and watched my videos, I love to go over technical analysis. It's an art form. It's something beautiful. It's something that it's fun to do when you really get into this, but it is not everything, because your technical analysis, it can be wrong. You can make mistakes on it. And when you develop your technical analysis far enough, the point is to be like, okay, I could win 50-50 without technical analysis, but with technical analysis, let's say I could bring that up to I win 60% of the time, or I win 70% of the time. Those of you that can win, and those of you that do win 80% of the time and higher, you're a phenomenal trader. That is excellence in the market, because that says if you can get a risk to reward of 1 to 2, 1 to 3, anything like this, because even if I scale this back to 2, that means 80% of the time you are making 100% more than you are losing on a trade. If you do the math on that, like, you're making profit over time. Let's take this for example too. If you're winning, I'm going to make some more text here. Okay, so let's say you have a 50% win rate, right? So that means you win a trade, you lose a trade. It's half and half. that means that if every trade that you win is 2 times larger than the trade that you lose, that means over time, that means in a series of 10 trades, you're going to have 100% more gains than you are losses, right? Because if you were to win 50% of the time, but your trades were 1-to-1, meaning that you lose the same amount as you won. Let's say, just for example, you risked 1% to make 1%, but you only won 50% of the time, you just break even, right? So with a 50% win rate, but a 1-to-2 risk reward, that means half the time you lose and half the time you're profiting, but twice as much is what you lose. So do you see how over time that's actually going to make you a profitable trader? And this is where, like I said, the technical analysis becomes important. Because if we can start creating positions where we're getting more than a 1-to-2 risk reward, this is where we start improving our profit margins. We start improving how much we're actually risking in pips, which means we can increase our lot sizes and actually take better advantage of moves that play out. And it means that we can also be more accurate about our targets. Because, I mean, even in this specific example, this went right back to the previous point of control. That would have been a great target had I personally been looking to short here, had any of you actually caught this ceiling right here that played out. So with that, and given what we have here, there's a lot of ways to be profitable in the market, and there's a lot of ways to be a loser in the market. Look, this is a beast, a monster that is out here trying to take your money. The sole purpose of the market is to try to separate you from your capital, which is why so few people actually end up being profitable in this over the long term. So when we can learn to integrate these things, and like I said, there is no perfect system I could say, hey, do this, this, and this, and that should work for you. Every trader is different. Everyone is going to look at the markets differently. Everyone is going to have a different tolerance for risk. Everyone is going to want a different thing out of the market. They're going to try to get a different thing out of the market. For some people, having a 50% win rate and making 1-to-2 trades that's sufficient for them because you're profiting, right? Over the long run, you're actually profiting. For others, maybe you want to take a $10,000 account and you want to flip it. Like you want to actually be doing high risk, but then you have to know, okay, if I take a huge loss on this, how is that going to affect my psychology? For some people, when you've done it enough, you get to this point where it's just like, okay, yeah, I know that I just lost like 20 or 30% on this small account, but I also know that the probability of my trading says that in the next 2 trades or the next 3 trades, I'm going to win a trade that should make back that loss in addition to make me some profit. Like, that the probability works in your favor so long as you stay neutral, so long as you're not either trying to make up for it. Because remember, the market, it shows up with 2 emotions. It's fear and greed. It is either the desire to, oh, I could make more. There's more here for me. I'm going to take. Or the like, oh, I've been losing. I'm afraid I'm going to lose all my money. Oh, I need to make more, blah, 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 blah. These things affect our mind. They affect our psychology. They affect our ability to objectively observe the price and make decisions based off of that objectivity. Because as soon as it becomes like, oh, the market's going to give me this, like it owes me this, like you get cocky about it, you get arrogant, you get complacent, the market's going to humble you. Likewise, as soon as, like, let's say this move, like I said, I was very bullish on this and I got stopped out on this. But because I'm aware that, okay, I'm not always going to be right, I'm not going to risk more than I know I can psychologically handle, more than I know that I'm prepared to lose on my account. Because every single trade that you enter, you should be prepared for it to hit your stop loss. You should not take a trade that's going to compromise your account, compromise your psychology, because remember, this is not about each and every trade. It is about the long-term game and how each quality trade that we take, accepting humility and accepting that gambling and trading are 2 different things. That is how we're going to be successful over the long run. That's how you're going to do it. So with that, that's a little bit on the 3 pillars, on how there's many ways to be profitable in the market, and it comes down to your psychology your ability to manage risk, the parameters to which you define your risk, what sort of risk to reward you're expecting out of the market, and then your technical analysis, which is just like the tip of the iceberg. It's understanding that technical analysis, the point of that is to improve your win rate. It's to improve the distance of your stop losses, the accuracy of your targets, your understanding of the market, to improve this beyond just a coin flip game. Because as I've stated many times, there is a rhyme and rhythm to this game, but remember, it's a complex game and a lot of people play this. A lot of people lose, but there are people who win successfully, consistently over time, and this is how it's done. So with that, I hope you all learned something from this video. Let me know if this was helpful. Leave any comments, questions, anything below. Like, subscribe, do whatever you want. Happy trading to you all, okay? Remember, there's a lot of elements to this game, and it is not a one-size-fits-all thing. So find your groove with it. Figure out parameters to where you could win consistently over time, and you could be slowly growing your account consistently over time, and you will be successful in this game. It is not about taking the heroic trade right now, okay? It's not about being a hero. Don't be a hero. The market will humble you. You have to respect the market, and the market will respect you. All right? Y'all have a great day. Take care.